And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the second best day of the week. It's Thursday as we get ready to wrap up the week. Of course, Memorial Day on Monday. Markets are closed, so we'll be back on Tuesday to pick up with you on what's happening in the markets. Of course, tomorrow we'll have Danny Ratliff, Richard Rosso here for Financial Fitness Friday. We got you taken care of. Plus, don't forget, a lot of people don't know that on our website we produce a ton of commentary outside this radio show. So if you're listening to this program, we appreciate you. Make sure to subscribe to the channel. But also go by the website, realinvestmentadvice.com. We provide 3 blogs every week, one on Tuesday, one on Wednesday, one on Friday. Tomorrow's blog, talking a little bit about the risk of recession, isn't zero. We have a weekly newsletter that we produce every weekend, full of market stats, stock screens, all kinds of stuff there for you. We also produce a daily market commentary. It comes out at 7:30 every morning, delivered right to your email inbox. Mike and I write that every day, have that to you before the market opens. All of that on the website, realinvestmentadvice.com. All can be emailed to you, absolutely free, no subscriptions, just put your email address in, and we'll keep you up to date. So even if we're not here for a day for the radio show, you're not going to miss all of what's going on because we keep you updated every single day with stuff. Just tons of information on the website, realinvestmentadvice.com. Okay, outside the quick plug advertisement. Look, we have 2 subscribers. We need some more subscribers. Go subscribe, will you? Just help us out a bit, will you? All right, no, seriously. So a couple things, obviously. We talked about yesterday, really 2 things that would move the markets today. One was the FOMC report, which was the minutes from the last Fed meeting. Those came out about 10 o'clock yesterday morning. Markets sold off on that news because they were, again, there was nothing new in that report, right? It was just basically the minutes are a kind of a structured, kind of a structured writing by the Federal Reserve that puts out, hey, we talked about this. And it's very carefully crafted. These aren't the actual minutes that you would have like in a normal meeting where people are arguing across the desk, right? So, no, this is a very structured, well-crafted release that comes from the FOMC talking about what they discussed in the last meeting. But importantly, while the market sold off because it seemed to be a little bit more hawkish in terms of its overall tone, talking about, well, inflation hasn't come down as much as we expected. It's been, we're still watching that data. We're probably going to be a little bit longer before we start cutting rates. Probably won't cut rates till September. That type of tone was coming from that. Well, that's the same thing that all these Fed speakers over the last week or so have been saying, right? So really the Fed members have come out and basically have already reiterated what that statement said. But nonetheless, the market was overbought yesterday. We've had a very big move here. So as we've talked about over the last few days, I pull back towards that 20-day moving average. A bit of consolidation won't be surprising at all. And again, that's just kind of where we are right now. But of course, the big news was after the bell yesterday, and that was, of course, the release of the earnings report from Nvidia, right? So that was the last big S&P company to report earnings yesterday. We're going to talk about that in a second before the bell. But we've also talked about the fact that deflation is continuing to be the bigger risk than inflation. And we've talked about previously that supply and demand is what creates inflation. That's it, right? There's no, you can come up with all these other excuses in the world, but at the end of the day, it's supply versus demand. Why did we have such a high rate of inflation? We shut down the economy, no supply. You gave people a bunch of free money to go spend. They all ran out to Home Depot to buy stuff. There was nothing to buy. Prices went up. That has now reversed. Now inventories are building, as we talked about slowness of consumers. We've talked about weakening consumer spending, all the running out of excess savings. And so we've seen in these latest reports from retailers a real concern here about traffic coming into these stores. Consumption is declining. People are starting to step down from higher spending areas to lower spending areas to sustain their cost of living. And now we're starting to see the other side of that, which is too little demand versus too much supply. Both Walmart and Target are now instituting cost cuts or price cuts, rollbacks of prices in their products to move that supply. That is that first phase of that disinflationary structure where companies now have to start cutting prices in order to get product move out the door. So again, that's just been a function of time coming, but we're now starting to see the evidence of some of that now occurring. Okay, let's talk a little bit about Nvidia. Here's what you need to know before the bell this morning. So yesterday in the daily market commentary, again, it's one of those reports you can subscribe to at the website, realinvestmentadvice.com. Absolutely free, comes to you every morning at 7:30. We went over the outcome for Nvidia and explained why we reduced our holdings in Nvidia before the earnings announcement. And so all we did is we've owned Nvidia for a long time. We buy and sell. When it gets really overbought, we trim it off a little bit. When it pulls back, we buy some back. And that's what happened back in April. The stock declined. And during this decline back in April, we added to our position. So all we did is this rally since April has been very nice. So we just removed what we just added. So we just took the profits and rebalanced our portfolio position back to target weight. And the reason for that was that what we've seen here this earnings season is that if companies come out and have really stellar earnings reports, they're not rewarded that much. But if they miss, or even if their guidance is just in line, like Palo Alto Networks as an example, the stock will be down 10 or 20% for the day. And so again, when we laid out, and this is what we did in the daily market commentary, we laid out the risk range of Nvidia. We said, okay, if they come out with just inline earnings meet their estimates, which were already very elevated to start with, but if they come out with that, the risk of that is about a 20% decline in the stock, and that would happen very quickly, take us back to support. So we had about a 20% decline priced into the market. We said if everything goes great and they announce super earnings, the upside of that is about 10%. So you had a risk-reward range that was almost 2-to-1 in that environment, which was why Mike and I decided to trim back that position to target weight, because it wasn't a function of whether or not we thought they would do well in earnings, because the trend of AI and what's happening suggested that their report would be fine. The risk was the guidance. Did they come out and say, hey, things are slowing down a bit, somebody's, maybe people aren't buying as much of these GPUs? That wasn't the case. Apple, Microsoft, Google, and Amazon, those 4 companies made up 40% of the sales of the GPUs for Nvidia during the last quarter, and the other remainder of that went to companies like Elon Musk's xAI, his new development, CrossWeave, who's building out data centers, others. So again, there's a lot of demand. Sales were up 426% annualized. So again, they're blowing it out on all cylinders right now. Stock is going to be up about 7% this morning. So right within our target range, because we had said that the markets it could be up 10%. We're about 7% this morning, last time I checked. Also, the stock is going to do a 10-for-1 stock split. So this $1,000 stock price is going to drop back down towards $100. Which will make it easier for more investors to get into the stock. So again, really good news kind of across the board for Nvidia. The AI trade still very much in place at this point. And one of the big things, we've got an article coming out on this next week, is talking about what comes off of AI trade is electricity, infrastructure build out, and most importantly, water, because it takes a tremendous amount of water to cool AI data centers. So that's some stuff we'll be looking at for you down the road. But that's what you need to know before the bell this morning. Market futures are up this morning. Everything's on kind of firing off in the technology sector because of Nvidia. So should be a good day, at least at the open this morning. All right, be right back after the break. Pick up with Michael Leibowitz, FOMC, Nvidia, Fed, Bitcoin, all kinds of stuff. We've got a lot of stuff to talk about this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
back to the show this morning. So a few things this morning to kind of go through. Michael Leibowitz, of course, joining me as well this morning. Well, we can just kind of pick up with the with Nvidia and AI real quick since we just finished up with that. Mike, anything jump out at you yesterday on the earnings report? He's talking, but I can't hear him. You have to start over. Brent had you muted. So
yeah, not surprising, Brent.
not surprising at all.
I think what's surprising is that their earnings estimates, which have been raised throughout the quarter and are just massive as far as growth goes, they killed them, right? They came in well above earnings, well above revenues. They increased their guidance. It's like whatever the market throws at them as far as expectations, it one-ups it. And I think what it really attests to is the growth of AI and how it is just becoming a massive part of our lives. And Nvidia just happens to be the first company not the first, but the biggest beneficiary right now at this stage of the AI build out. Their chips are used in the data centers, and they're building data centers like crazy right now. So, think of Nvidia as that first leg of the AI build out, and there's still so much more to come, but it's just the growth and the speed of the uptake of this technology just dwarfs prior technologies, and it's just amazing to me.
Yeah, no, and there was actually I was reading a very interesting article last night talking about this as well, as that one of the things that is becoming a bit more of a benefit here is that the markets are now seeing that you can actually make money with AI, and what they're talking about here specifically is that, let's say you and I go out, we're going to build a company, and we're doing this right now. So we're building some AI technology to use inside of SimpleVisor. Well, we've got to train that data set, and so what these data centers can do and what they're figuring out is that for each dollar that they spend on GPUs, they can basically rent those GPUs out for $5 an hour to train other people's AI models. There's and of course the H100s, which is the next generation of GPUs that are coming out. It actually ties to Meta's Lima product, and they'll be able to rent those out at $7 an hour. So basically, you're talking about something you can rent for $1 and lease it out for a 400% profit or 600% profit, depending on which product you're using. So now the markets are starting to see that these data centers that are providing this ability to train other people's AI models, to basically provide them the engine to train their AI models with, is actually going to be a fairly big revenue generator. So that's also starting to feed into this, because as more data centers figure this out, then that means more demand for Nvidia's GPUs, AMD's GPUs, etc. Because Nvidia is not the only player in this, right? It's just they're the biggest. They're kind of the gorilla in the room, but AMD's in there. There's a couple of other computer companies that are playing in that space well. And of course, as Mike and I have talked about before, this surge in activity is also going to bring in new competitors. So as people are making more and more money, somebody's going to figure out a better way to build a better GPU, a better mousetrap, whatever it is, and there'll be more entrants into the space. So again, it's great right now. But one of the kind of the byproducts of this, that's kind of the cloud on the horizon, is that and we saw this happen with Apple, we've seen it with other companies, that they keep beating earnings, they keep crushing earnings, then Wall Street starts to aggressively up those those estimates, right, to where it becomes a challenge for the company to actually meet those, because Wall Street kind of gets a little bit too far ahead of itself.
Well, but even with their earnings, the stock's up 7%, which is outstanding. But I feel like if this was any other stock and it beat earnings and provided guidance like they did, it would be up 20 or 30%.
Right. Well, I mean, but the stock's up 25-fold since October of 2022. So right. I mean,
right.
Right.
They needed perfect earnings,
yeah,
and they pretty much got perfect earnings. I think anything short of that, like you started with, would have been disappointment. And disappointment doesn't mean down 20%, but it may have been a flat stock or down 5%. Yeah. Even if earnings beat estimates and revenue beat estimates, but their guidance only beat their old guidance by a little. Yeah. I mean, they needed perfection and they hit a 10.
Yeah,
they got a 10.
Absolutely. And of course, the 10-for-1 stock split certainly didn't help things. Didn't hurt things. Didn't hurt things at all either.
Absolutely. They open it up to retail. Retail can buy the stock much easier at $1,000 a share. Retail tends to shy away. They think it's too expensive.
Yeah.
And again, expensive has nothing to do with the price of the stock. It's valuations, which we talk about all the time.
Right. But, of course, it's even a problem for us. So like, in smaller account sizes, right? So, we run a risk managed model. So we risk size positions within a portfolio. So Nvidia is supposed to make up a certain percentage of the portfolio. Well, in a $100,000 account, as an example, because I need easy math this morning, haven't had enough coffee yet, $1,000 stock is a 1% position. So if I want to buy, just 1% of the stock, I can buy one share, right? So, but at $100, I can buy 10. So it makes it so, one thing that will help, the stock split will help. It increases liquidity for the stock, but it also provides even portfolio managers like us the ability to better manage risk in a portfolio because you don't have such a large dollar value of a stock price.
Right. And we also, a lot of stocks in our portfolios are 0.5%. So it's 2.5 or 3.5. Yeah. And we can't make Nvidia 0.5%. It's either got to be 1%, 2%, 3%, whatever, an even number.
Yeah, exactly. So anyway, it was an interesting day. And one thing that, Mike and I are talking about, in fact, Mike has an article out on the website this morning, actually speaking to one part of this. And he's in his article is talking a little bit about AI data centers and EVs. The artificial intelligence boom is not surprising. And everybody's been talking about this for a long time now. We've had artificial intelligence for a decade. It's really starting to find its foothold. But now we have to start thinking beyond just Nvidia and just the impact of what AI is, but also all the other beneficiaries that come from that. And so we've got a couple of articles that are coming out over the next week or so. Mike's article today, next Friday, I've got another article coming out talking a little bit different structure about how this innovation can impact economic growth. But, this is we have to start thinking beyond it. It's kind of like, you want to buy gold. That's great. But you also have to think about the miners, right? Because you got to get the gold out of the ground. You got to process it, all those type of things. So, there's always the picks and shovels side of any type of thesis. So in this case, AI is the gold, right? The GPUs, the data centers, that's the gold. Well, what else do you need to support that? And this is something that, Mike and I have been starting to think a lot more about, talk a lot more about amongst ourselves, starting to build some positions in our portfolios, thinking about a longer term thesis of, things that are all going to be involved and supportive, or things that are going to be required in order to support this AI generational build that we have coming along. And Mike, it's not just AI, as you pointed out, there's a lot of other things that are going to feed into this thesis as well.
Right. And, you look at, in my article, I start with the California gold rush, and you look at that and who made the most money. And there were gold miners that I'm sure made a ton of money. Mm-hmm. Levi Strauss, providing jeans, denim, hardy pants to these miners, which they desperately needed. So the answer, while it looks like Nvidia is the answer to who's going to profit most, over the long run may not be as obvious, especially Nvidia's already had a huge run up. So the answer of who the next Levi Strauss is may not be as obvious as Nvidia or AMD or Microsoft or Google. Mm-hmm.
Right. And that's, and this is part of the conversation, something that, we've got to start looking at, and we've recently been talking about electricity generation as one of those avenues, and who's going to provide that, because we haven't been building out infrastructure, particularly power grid infrastructure in the U.S. Right. for the last 25 years, and some of our power grid infrastructure is very, very weak at best. So there's going to be a lot of dollars required to upgrade that infrastructure power grid. And of course, the government will get involved in this as well. I'm sure as the demand becomes much more obvious, we'll get spending bills passed to build out power grid infrastructure, et cetera. And the reason is the outside of everything else, the government has, according to the Constitution, the government has two responsibilities only, and that's national defense and infrastructure. That is the government's job, is to provide that. Now, all the other stuff the government gets into, that's not their business. Education, energy, all that belongs to the states, should be in the states. It's not. Government's got involved in it, and you can see the results of that, obviously, with our educational system. But at the end of the day, the government is responsible for infrastructure and national defense and electricity and power and potentially water is going to fall into that category. We'll talk about that when we come back from the break because it's not just AI feeding into this problem. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Food in total is now making up 30% of the average discretionary income.
I believe it. I mean, that is our largest expense is food. Yeah. And we rarely eat out.
The Real Investment Show podcast.
Our biggest frustration at home is how do we do this cheaper?
Yeah. No, I agree. We're running Hunger Games at our house.
At realinvestmentadvice.com.
So, if you can make it to the table without getting killed, you get to eat.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Michael Leibowitz joining me, talking a little bit about, well, it started out talking a little bit about AI and Nvidia. And, you know, the thing we have to start thinking about, and again, we've got a couple of articles out on this right now. Michael has his article out. It's on the website now, realinvestmentadvice.com, talking about Bitcoins and EV and that impact on, you know, electricity and power, but then also AI and what that means for electricity and power usage. And again, so when you start thinking about where we're going in the future, you know, power is going to become a much more valuable commodity because we're demanding so much more of it. Mike, you wrote a little bit of, you know, it's not just, you know, already we're consuming a tremendous amount of power as Americans, right? We have to charge iPhones and computers and lights and our refrigerators and everything else. So we're consuming a tremendous amount of power already, but now we're starting to introduce more and more things that are all power driven. And at the same time, we're looking to switch from traditional power generation to other types of power generation that are not nearly as efficient, i.e. solar and wind, in producing the power that's needed. So there's going to be some advents in the future that, again, as I left off talking about in the last segment, the government's job is to provide national defense and infrastructure. And one of the things that is most important to both national defense and infrastructure is power, right? So, I mean, if we don't have enough power, you know, we don't run national defense and we don't have infrastructure, and basically the economy starts to break down very quickly. I can tell you that from experience being in Houston this past weekend with no power. I mean, people were losing their minds for not having power for a couple of days, right? Can you imagine not having enough power and you're out of power for weeks, right? There's talking about anarchy. So infrastructure and national defense is very important when it comes to power, which will mean that we're going to see a lot of government spending in the future, and it's not by their choice. They will be forced to spend money on building out the power grid because of the demands that we are doing now. And this is, and again, it's not just AI. You made some excellent points inside your article talking about the demand consumption of Bitcoin mining and electric vehicles.
Yeah, the problems facing our power grid are immense. And what that means is that the opportunities to invest into our power grid are huge. And like you said, it's even if AI didn't come around and even if there were no EVs or Bitcoin, the power grid, it's estimated that about three quarters of our power grid is more than halfway through its useful life. So just the upkeep on a power grid is going to involve a decent investment. Now we have a lot of renewable energy goals that are only, you know, this whole net zero by 2050 and a million other goals just forces further strengthening and building onto our power grid to be able to accept and deal with these new energy sources. And now all of a sudden you're throwing in data centers and EV, electric vehicles, and Bitcoin to a smaller degree. And the amount of investment into the power grid, both by the government and largely by the private sector, are going to be immense. I think it was Wells Fargo actually thinks that by 2030, just from the addition of data centers, that the terawatt hours of electricity that are going to be needed just for those new data centers is the equivalent of 48 New York cities as far as energy usage. So think about the power grid. If we're going to build 48 New York cities, that's what's going to be happening, in addition to the upgrading and the renewable energy aspect of it. So it's just the build out is going to be immense. And like we said, there's a lot of other players that are going to profit, from this. And it's, and some of it is the energy suppliers. Who supplies that renewable energy? Who supplies natural gas? Who supplies the other energy sources that are used?
Yeah, nuclear. And nuclear is going to be probably a very big player in this. The problem with nuclear is it just takes 10 years to build a plant. So, it's a very long lead time on nuclear. But that's going to be, and again, and I think, Mike, to your point, the reality is that we're going to need so much power that the ability to use solar and wind is going to become really a much smaller byproduct of the energy production. Just simply by force, we're going to have to focus on both natural gas and nuclear as the electricity provider, because it's just that those are the only two sources where you can provide enough electricity. The conversion ratio of those energy sources into electricity is the highest and also the cheapest. Honestly, we have just a tremendous amount of natural gas. Nuclear energy is plentiful. So, the government's going to be forced to transition from solar and wind into natural gas just simply by the demand structure alone.
Yeah, I agree. Natural gas, at least for the next 5 or 10 years, is the big winner because it's plentiful, it's dirt cheap. It's basically trading at 30-year lows. And, but then, you can start looking at, well, should I buy, the drillers of natural gas? Should I build, go to the midstream, which are like the pipelines? So there's a million investment decisions to be made, even if you think the answer to just one segment of this big investment puzzle, just the energy source. There's various companies you can buy that are involved everywhere from getting it out of the ground to the utility itself that's buying that natural gas or, whatever the energy source is. And when you kind of work through everything, there are so many different ways to play this growth of the power grid. It's just amazing. So I put an article out on this. Part one came out yesterday, and all it does, part one, is just lays the groundwork for what has to be done to the power grid, the massive expansion, and potentially what it'll look like. Parts two is when we start. Part 2 and 3. Hopefully, I ended at 3. But the more I work on it, the more I'm scared there's a part 4. I just start diving into these industries. So part 2 is going to be natural gas, nuclear. I couldn't even fit alternatives in there. I had to leave alternatives out. And Lance, it's not just data centers. EVs are growing. And if and when they solve that battery problem and they make recharging stations a lot
efficient,
have a lot more of them, EVs could really take off here. So, maybe 5 years from now, when there's a solid state battery in theory, which gets you 700-800 miles per charge, when you can charge in 15 minutes or 10 minutes, EVs take up much more of the ratio of cars on the market. So that too is a drag. And then there's, when you use AI on your phone, on a Google app or ChatGPT, it uses almost 10 times the energy as a normal Google search. So, it's not just the data centers, it's that we're going to be draining the power grid. And there are battery companies and there's air conditioning companies. Like you said, water companies. I mean, cement companies that are building out these data centers. Just the million ways to invest in this is incredible.
Well, and real quick though too, right now natural gas has had a big boom here recently. Copper has had a huge run as of late. Nuclear or uranium has had a big run. Understand these are very long-term outlooks that we're talking about here. This is stuff that's going to develop over the next 10 to 20 years. So we're starting to make investments today that are going to be 20 years into the future. But again, these commodity prices are going to be all over the place. They get, there's, like I said, you're having a big run in natural gas, you're having a big run in uranium. Those are going to crash at some point. You're going to have a big reversion in that. And that doesn't change the thesis. It's just that, remember, commodities, whether it's gold or uranium or copper or silver, these are driven by commodity markets. And so all the traders get in there, they're trading commodity futures. That's what moves the price. and they get ahead of themselves. And then at some point, somebody says, hey, I'm out, and you have a big correction in price. That's going to happen repeatedly over this next decade. These commodity prices are not just going to go straight up. These utility company prices aren't going to go straight up. It's going to be an ebb and flow over time, but the revenue potential that is going to come out of this for these companies, particularly utility companies, et cetera, is going to be good. It's going to help support that growth of those assets over time. But understand there's going to be a lot of booms and busts along the way. So, don't be surprised that if you jump into something today thinking, the AI is going to, cause this to happen and natural gas is going to go to $15 an MCF. That may happen, and then it's going to crash, and then it's going to do it again. This is going to be a repeated process over time. And water, water's, and to Mike's point, JP Morgan put out an article, research paper this morning talking about 2030, water consumption could jump to 450 million gallons a day. To put that in perspective, that's about 681 Olympic-sized pools every single day in water. And that's just on current assumptions by 2030. We don't have enough water for that. So water generation is also going to be, converting seawater to potable water, et cetera, is going to be another big evolution of all this as well. So again, there's going to be, like Mike said, just tons of way to play this, but just something to start thinking about because the world is changing and we're about to enter into a quote unquote industrial revolution like we have not seen since the 1920s. And that has a big impact. And this is part of our story for next Friday. This potentially changes the dynamic of debt and spending to a productive side of growth for the economy, for jobs, for incomes, wealth distribution, etc. A lot of positives come out of it. All right, come back. We're going to talk a little bit about the FOMC after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show. We could spend 5 shows talking about the future of AI and what's going to happen with power, infrastructure, economic growth, etc. And this is going to be an ongoing theme that we'll be talking about over the next several weeks like I said, Mike's writing some articles on it. I've got an article coming out next week on the positive impacts from this. One of the big concerns has been the debt, right? And I see a lot of misstatements about, currency issuance and things like that are not valid statements at all. But one of the concerns has been, and rightly so, is that we've been issuing debt for many, many years now for non-productive uses. If you start issuing debt to build out power grid, that's a very productive use of investment. We did it back during World War II when we built the Hoover Dam. Not World War II. Coming out of the Depression, we built Hoover Dam, Tennessee River Valley Authority. You spend debt to do that. You then charge customers to use that electricity. That debt, it now becomes an investment that pays for itself over time. And once the debt is repaid, it becomes a continuing revenue source for the government. And that is going to be the case from this going forward. So, one of the problems has been with the debt issuance is no way to really grow out of the debt issuance because we haven't been using it for productive purposes. You start spending billions of dollars on productive investment, all of a sudden you can grow your way out of the debt problem. So that is a positive benefit that could come from this, and we've got an article coming out on that, like I said, next Friday. So let's switch gears here real quick. And again, we'll be reviewing this topic from time to time, but let's switch gears here real quick, Mike. FOMC minutes yesterday. As I mentioned kind of at the outset of the show this morning, I didn't really see any difference in the FOMC minutes versus what the Fed speakers have been saying this week, saying that inflation is still a little bit stickier here. No real discussion by Fed speakers over the last week about potentially hiking rates, just, maybe just not cutting rates until September. QT still seems to be on track to get reversed by June. Anything in there that, you saw differently?
I just thought they were a little more wishy-washy than normal. We're too restrictive. We're not restrictive enough. Maybe we're going to be cutting rates soon. Maybe we're not going to be cutting rates at all. Maybe we're going to be raising rates. I mean, there was a lot of that kind of language that they were going in every direction, like saying, we have every option available to us. But there were, actually the bond market's reaction to it was it didn't move.
Right.
The stock market fell, the S&P fell 20, 25 points, whatever it was, because they heard the word the Fed could potentially increase rates. The bond market literally did not move during when it got released and in the hours afterwards. And, it actually trickled higher slightly afterwards. It's up a little bit more this morning. I just think the bond market took it for what it was, is just the Fed doesn't really know what they're going to be doing.
Well, and the stock market, we've been talking about this on the show for the last, every day for the last week. And Mike, because we write this in our daily market commentary every day, market's overbought. We need a correction here. We're very extended. Market just needed a reason, and those minutes were a decent reason just to maybe take some profits off the table, particularly, excuse me. And it may not have been so much as the FOMC minutes is just basically traders taking some profits off before Nvidia earnings, because if they had missed earnings, the whole market would be down today. So
that's what I was going to say as well.
Yeah,
and look, 20 points on the S&P is nothing. I'm not like you. I'm not sold that the market saw those minutes and said, "Uh-oh, we're in trouble." And it's gotten it all back this morning and a little bit more. So, over the course of 24 hours, it's gone nowhere too, like the bond market.
Yeah.
But
that kind of my point though is that the minutes, and again, like I said this morning, or at the outset this morning, these minutes are a well-crafted statement. This isn't the actual minutes. It's not like, every day Mike and I have an investment policy meeting. And we talk about our investment strategy and all this, and it's recorded by artificial intelligence, by the way, that records it and then spits out a transcript of our minutes. And it says, Mike said this, Lance said this, Nick said this. And it's just basically a raw transcript of our conversation. And it's great, right? So we file that for compliance purposes. It's awesome. But it's a very jumbled mess, right? Because it's just, me and Mike talking and Nick talking and topics are shifting. If you take a look at the FOMC minutes, it's not that way. This isn't the live minutes of that meeting. This is a well-crafted statement of what was discussed during that meeting that's put out by the FOMC. So it's quite different than actual minutes. But but my point was, Mike, is that we've had a lot of Fed speakers over the course of the last really several days, and most of their messages were pretty much in line with each other. I didn't see, they seem to be much more coordinated in their messaging over the last week than what came out of those FOMC minutes, where it was kind of a jumbled mess of opinions.
And I think that's the important takeaway from this week in regards to the Fed. They are on the same exact page, all of them. And that's not usually the case. Usually there's some outliers that want to do something a little differently. They're all on the same page. They're all a little concerned that inflation is going to be sticky. None of them are really concerned that inflation is going to start going back up again, but they're concerned that we're going to be stuck at this level of inflation for a while. There was some hope that the last CPI number will start bringing on better numbers. A lot of them spoke about the housing component within CPI, and they're waiting for that to come down, which a lot of them think will occur. They are starting to show a tiny bit of concern about employment, and kind of from a broad takeaway, there seems to be this feeling that if unemployment keeps ticking up, even if it's just a tenth or two over the next meeting or two, and employment and inflation stays where it is or drops a little, that could be enough of a trigger to discuss rate cuts. Doesn't mean they will cut rates, but that may be enough to get the conversation going. So we're back to this employment matters and prices matter. For the last 2 years, 3 years, whatever it's been, prices are what's mattered to the Fed. So we'll see. The other thing that weighs on the Fed, and one of our discussions we've had over and over again is, why does the Fed want to cut rates at all? And we're starting to see that in the commercial real estate sector. We know what's going on with office space, right? The vacancies are very low. People are working from home. Companies don't need as much space. The vacancy rate's high. And we're seeing a lot of these office buildings trade for 10, 20 cents on the dollar for what they traded at prior to COVID. And it's a disaster. But we're also seeing this occur in hotels and residential. And the question there is why? Let's just focus on hotels. Travel's been good. The vacancy rates for hotel has been high. So why are
the vacancy rates of hotels have been low, not high?
Low. I mean, right. They've been fully. I think I've screwed up the whole vacancy thing this whole conversation. But
we got you. We're with you.
There's a lot of people staying in hotels.
There you go.
The problem is a lot of the debt on the hotels was taken out in 2018, 2019, 2020, 2021 when rates were very low. And that debt, unlike your mortgage, are balloons. So they adjust in 3 years, 5 years, 7 years, depending on the terms. So what happens is that they got a great rate. Maybe they're borrowing at 4%. But when that loan comes up for adjustment, it's going to go to 8, 10, or 12%. And all of a sudden, the cash flows don't work. Even if the hotel is fully booked, it just doesn't work. So that's why we're starting to see a lot of some defaults in places that we shouldn't see them based on the economy. And that's why the Fed is, that's one reason the Fed's concerned, because this is very leveraged space. And there's a lot of investment dollars in commercial real estate that can have a trickle-down effect into other assets.
Yeah. And again, and one thing that is important about this is that, about the last year, Mike, everybody's been, kind of waiting for this real estate crisis to unfold in commercial real estate. And one of the things I've been discussing a lot more as of late is that may not happen because, for instance, there's a building in Sugar Land, which is a city that's just south of Houston. Back pre-COVID, this building was worth $143 million. It's about to sell. There's a sale pending on it right now for $11 million. Building is in fantastic shape. Nothing wrong with it. It's just been basically sitting vacant this time, and so the bank wants to get it off their books. One of the things that happened during the financial crisis was that we had all these loans on the books, and when Lehman went bankrupt, you had counterparty risk. Nobody wanted to trade with each other. So nobody wanted to sell a bond to somebody else. Nobody was willing to buy a bond from somebody else. So these mortgages just froze, and they didn't trade. And so everything sank at one time. What we're seeing this time is banks are getting these properties off their books. Yes, they're selling them at cents on the dollars to get them off their books so they don't have that liability risk of something unfolding. The FDIC steps in and says, okay, you're done, and we're going to liquidate all your assets at once. I told you I'd gone to this distressed debt conference about a month ago, and there is a tremendous appetite. There's about 500 companies that deal in distressed debt around the country, and they have a huge appetite for that distressed debt, and they're being funded by companies like Fortress Investments, BlackRock, et cetera. So as soon as they find a deal, they send it up to Fortress or BlackRock. They fund it. These deals are going off and getting liquidated. So, we're seeing that process of that liquidation occurring. So we may not have that big shoe to fall that everybody has been expecting. But again, it doesn't mean there's not a negative impact to the economy because of this. It just may not be the financial crisis a lot of people have been expecting. All right, wraps up the show for today. Mike, thank you so much. We'll be back tomorrow, like I said, with Danny Ratliff, Richard Rosso. Of course, they'll be here Financial Fitness Friday. Monday, we're off. Back on Tuesday. We'll get you all updated with everything. Of course, as always, have a great day. Make sure and like and subscribe to the channel. We certainly appreciate it. Don't forget, get by realinvestmentadvice.com. Lots of stuff there if you're not just getting everything you need here from the show. We have lots of stuff there. realinvestmentadvice.com. See you tomorrow.